What's up, everyone? Welcome back to our video blog where we dive into the ins and outs of the real estate world. I'm Brad Cohen with Connexa Real Estate. Thanks so much for tuning in. I just got back from Side by Side, which is my company's national conference, and I got to connect with the best of the best agents. One of my favorite keynotes was an economist discussing predictions for the 2024 housing market. So today, we're venturing into the future. Specifically, we're going to explore predictions for the 2024 housing market, and I'm going to give you my notes from the keynote. Whether you're a first-time home buyer, a seasoned investor, or someone considering selling your home, understanding where the market is headed is crucial for making informed decisions. Now, predicting the future of real estate isn't an exact science. I'll tell you, Rick the economist said if you're an economist, the joke is to give a number, not a date, or a date, not a number, and if you're right, don't act surprised. I got a good laugh out of that. So take everything I say with a grain of salt. I'm not an economist, but by analyzing current economic trends, economic indicators, and local market dynamics, we can get a pretty good idea of what's on the horizon. This may get a little long-winded, so stay with me, but I'll try and cruise through just my most important notes. Looking at the overall state of the economy, things are pretty good. GDP remains strong despite the overall pessimistic outlook. Unemployment is still very low, and there are still more jobs available than people looking for them. Wage growth has been increasing and should outpace inflation now that we've gotten it more under control. And consumers keep spending money. So why the pessimism? Why does everyone seem to think the economy sucks right now? Best speculation is that food, gas, and energy costs drive consumers' opinions. And that's what's felt so expensive over the last year. Now, there are some red flags. Credit card debt and defaults has been rising dramatically, probably due to those core costs I had mentioned, and savings are declining. Not a good look, and many of you may be feeling that pain yourselves. The Fed has never raised interest rates this quick, and while a soft landing looks possible, we still have an inverted yield curve, which almost always precedes a recession. That said, economists are optimistic that if there is a recession, it should be mild, and unemployment numbers will indicate how mild. Okay, that's the economy. Now let's look at housing specifically. Rates could get to just below 6% by the end of the year. Expect that they will ping pong up and down throughout the year depending on economic data. Pending sales are up, which is a good indicator. The rate lock effect that I've described in other videos will keep inventory levels low. This is not about pickiness, because a lot of people do want to move. It's about math. They simply can't afford the monthly payment change in these new higher interest rates. The inflection point where we might see that start to turn is rates at 5.25 to 5.5%, which if we get there, we'll have a massive flood of new buyers, higher competition, and still no houses for sale. Despite what the news will tell you, the number of price reductions are not dramatically changing in a broader context. And most homes are still selling for 99% or more than list price. Another myth in the news, housing starts are down, meaning builders applying for permits. They are down for multifamily development, which are typically rentals, but they are actually up for single-family homes, which is good news for buyers in desperate need of more inventory. So why consider a new construction? Simple, they are available. Here locally, they're making up almost 30% of our sales, and the median differential in between new homes and resale homes is contracting. In layman's terms, it used to be a lot more expensive to buy a new construction versus resale. Now, not so much. Another interesting fact, 30% of home sales are coming from investors. Yes, I'm sure we've all heard in the news that Blackstone is buying up all of America's housing and we're all screwed. While that may be happening, tinfoil hat, stats actually show that these are mom and pop investors who own less than 10 properties. So what that really means is more average people are buying investment real estate. By the way, if you're an agent watching this and you're not working with investors, you are missing out on a huge segment of the market. Finally, a brief note on foreclosures and distressed properties. We are not going to see a massive wave of foreclosures. Are you hearing this ongoing motif of don't trust the headlines? We have seen an increase in delinquencies, which is a red flag, but most are 30-day and very few are actually related to mortgages. Mortgage delinquencies are basically leveled to a historical context. Foreclosure rates are typically 1 to 1.5% in normal market conditions. Right now, we are at 0.6%, extremely low. Also, 80% of borrowers in foreclosure have 20% or more equity in their property, so they can sell or refinance and avoid foreclosure. So there you have it, a glimpse into what 2024 might have in store for us in the housing market based on some economic data. Thanks to Rick at CJ Patrick Company for all the insights, and thanks to all of you for watching and let me share my notes. Hopefully this was beneficial. Remember, no matter what the future holds, being prepared and well-informed is your best strategy in real estate. If you have any questions or need personalized advice, don't hesitate to reach out. Always feel free to call, text, or email me. Brad Cohen with Connexa Real Estate. See you next video.